Hi, this is Aarti Singh and welcome to the head and tail video. I know you have already read a lot of articles and watched many videos around MDR on UPI. I just hope this doesn't turn out to be one more video saying same things. Here I will try to share a perspective along with insights that you may not find anywhere else outside the head and tail. So let's start. On Tuesday, the government introduced a bill to amend the Payment and Settlement Systems Act 2007. No, it does not bring back MDR on UPI or RuPay debit cards. It doesn't change anything immediately for merchants, banks and payment companies. Basically, the amendment gives the government the power to decide whether merchant discount rate, which is MDR, should apply to one or more digital payment systems. For the first time, the government can change the pricing framework for digital payments without having to amend the law again. The government now gets the legal flexibility to introduce, modify, remove MDR for different payment systems in the future. Now, the amendment has also reignited a debate that has been going on ever since the government brought zero MDR policy for UPI payments in January 2020. In order to understand why this bill matters, we need to first separate three questions that are often mixed together. Why the MDR debate keeps coming back, whether UPI is really free, and what the amendment actually changes. Now, launched by the National Payments Corporation of India, which is NPCI, in 2016, UPI today accounts for nearly 88% of all digital payment transactions in the country. Last month alone, it processed 23.66 billion transactions worth 30 lakh crore rupees. As UPI has grown, the debate around who should bear the cost of running such a massive payment infra has also become louder than ever. Acknowledging this tension, the Parliament Standing Committee on Finance submitted a report earlier this year saying that while the zero MDR policy has helped UPI grow massively, but it has also made the ecosystem financially unsustainable. The industry has been repeatedly urging the government to bring back MDR, if not for all, at least for the large merchants. And at the same time, the government has been reducing the incentive pays out to the ecosystem as a compensation for the absence of MDR. The annual incentive payout has now fallen to around 1500 crore rupees from 3600 crore it once was. Now, this is a clear signal that the government has finally come to a realization that zero MDR cannot be indefinitely subsidized. While there is no clear pricing or anything from the government yet, but several reports say that there has been a specific proposal under consideration, which is to bring back MDR on UPI payments for businesses with annual turnover of above 1 and 1.5 crore and only on transactions above 2000 rupees. MDR fee of about 25 to 35 basis points, which is 0.25 to 0.35%, is expected to be levied on UPI payments. Now, whether this proposal actually comes into effect or not, the new bill has ensured one thing, that the conversation around UPI pricing is back in focus. Now, before we understand what this amendment actually changes and who will benefit or lose, we need to first address one assumption that this entire debate is built on. Now, most discussion around MDR starts with the belief that UPI is completely free payment system. The law certainly says so. Section 10A of the PSS Act prohibits any charge directly or indirectly on UPI transactions. But does the market actually work that way? Okay, before that, let's touch upon the consumer side briefly. In a press conference this week, responding to a question on what if MDR comes and merchants pass that cost on to the consumers, RBI Governor Sanjay Malhotra very aptly put it that somebody is already paying for the system today. I can only assume that he was referring to the government's incentive payouts for UPI ecosystem, which is funded by taxpayers. Now, but this is only one part of the story. The biggest question is whether UPI has really been MDR free in practice. The answer is both yes and no. Before that, let's first understand the UPI ecosystem and the economics behind it. Every UPI transaction involves several participants apart from the customer and the merchant. First is NPCI, which is National Payments Corporation of India, the developer and operator of UPI. Then comes acquiring ecosystem and issuing ecosystem. Acquiring ecosystem is referred to merchant side of things. Fintechs and banks onboarding merchants on its platform through, say, QR codes, POS machines, and online payment gateways. For example, a Kirana store is using Paytm QR, Pine Labs POS machine, and if the store also sells online, has a website, and it is using payment Razorpay payment gateway, for instance. So here a customer is paying the seller, which is the merchant, via these options. So the QR company, the POS company, and online gateway are part of the acquiring side. Basically, whose merchant is it? These are the companies who go to merchants, negotiate, and convince them to use their payment processing services. These fintechs are called payment aggregators by the RBI. There are total 70 licensed payment aggregators in the country. These companies work and deal with businesses, enterprise, merchants, sellers, community directly. Also, the merchant's bank account where the money is settled is the acquiring bank. Now comes the issuing ecosystem, usually the consumer and buyer side of things, basically whose platform the buyer is using to pay. Now these fintechs are called UPI TPAPs, third party apps. The largest TPAPs are PhonePe and Google Pay. Then there are major ones like Paytm, Navi, Cred, SuperMoney, WhatsApp, Amazon Pay, MobiKwik, among others. In total, there are 41 TPAPs in the country. Overall, there are 92 apps, including bank apps, using which you can make UPI payments. Now, the bank account customer is using is the issuing bank here. Then there are PSPs, which is Payment Service Provider Bank, the banking partner of TPAPs, such as PhonePe and Google Pay work with banks like Axis Bank, Yes Bank, State Bank of India, HDFC Bank, ICICI Bank. The point is that the major PSP banks are also the top issuing banks in the country, which means majority people in the country bank with them. In addition, most TPAPs also have their own PA license, which is payment and acquiring side of the payment ecosystem. Now the fact is, even when merchants paid no MDR, money flowed into the UPI ecosystem. For every UPI transaction, banks paid NPCI 1 basis point as a switching fee. So irrespective of whether MDR existed or not, NPCI continued earning revenue for operating the network. And the incentive which the ecosystem got from the government largely flowed to the banks, especially issuing banks, which then shared a portion of their earning with their TPAP partners. In reality, however, only the largest TPAPs, which is PhonePe and Google Pay, received meaningful incentive payouts, and even Paytm to some extent. This also became a major point of friction within the industry because the rest of the ecosystem, which is smaller TPAPs and payment aggregators, got no share in the incentive. The incentive pool was divided broadly as 40% for issuing banks, 40% for acquiring banks, 10% for TPAPs, and 10% for PSP banks. Nearly 60% of the incentive flowed to the issuing side of the ecosystem. PhonePe, being the largest TPAP, used to get around 15% of the total incentive pool. Now coming back to whether UPI is MDR free. Now zero MDR on UPI meant merchants cannot be charged a fee by bank or payment companies for accepting UPI payments. That is what the law says. In practice, however, the market evolved completely differently. Now let me break this myth for you, which I have time and again written about. The reality is many popular online payment aggregators such as Razorpay, Cashfree, PayU, among others, have continued to charge merchants some sort of fee on UPI transactions under labels such as platform fees, technical fees, experience charges, or a single bundled payment gateway price. Some now don't even bother with the label anymore. They just quote a flat 1 to 2% for UPI processing with no asterisks and no explanation. Payment aggregators have earlier told me that these fees are not for the UPI transaction itself, but for value added services such as reconciliation, accessing dashboards, and payment management tools. And apparently on paper, merchants can choose not to use these services and process UPI transactions at zero cost. Now the most important part is whether small merchants are aware of this choice or have bargaining power to opt out is another matter altogether. And also in some cases, merchants do pass on this cost to customers through convenience fee or other charges. So while consumers may not pay any fee for UPI directly, someone in the chain ends up bearing the cost for processing a so-called free UPI transaction. The ground reality is UPI's merchant ecosystem is like two different world economies operating under the same network. Millions of small merchants like Kirana stores, neighborhood businesses, small online sellers, and service providers make up to like 80% of the total merchant base, but account for only a small, say 20% share of the total transaction value. And large merchants such as Reliance Retail, Tata, Amazon, Flipkart, major fuel retailers, telecom companies, utility providers, large organized retail chain, on the other hand, represent only a fraction of the merchant base but contribute 80% of the total UPI payments values. So now what happens is, large merchants understood regulations, had the scale and bargaining power to negotiate commercial terms, whereas small merchants did not, because they neither had bandwidth to understand regulation nor had the negotiating power to question a bundled pricing structure, challenge a platform fee, or escalate a dispute to the RBI's ombudsman framework. Now let me tell you one thing, the scale of this informal charging is not trivial. Industry estimates the revenue payment aggregators generate from UPI linked fees, whatever label it is used under, is somewhere in the range of some 1,000 crore rupees. Now let's look at it through some international context and experience, because this was not the first time that a policy maker in a country was trying to make digital payments cheaper for the merchants. Now more than a decade ago, the US capped debit card interchange fees through the Durbin Amendment after large merchants lobbies argued that payment acceptance costs were too high. The argument was payment costs for merchant would translate into lower prices for consumers, but that is not how it played out. One of the most cited post-Durbin studies by the Federal Reserve Bank of Richmond found that benefits were distributed unevenly across merchants. Merchants selling high-value goods reported some of the biggest reductions in payment costs, whereas sectors dominated by small ticket size transactions reported little benefit, and in some cases even higher cost after the pricing standard changed. In other words, regulating payment fees did not eliminate cost, but rather resulted in an uneven playing field. I will share links of my previous stories below. Please have a look at them. Now comes the definition problem. Many commentary around the amendment has been on specific framing. MDR should be brought back, but only for large merchants. That sounds fair but difficult to implement. And why do I say so? The first problem is definition. What exactly is a large merchant? People are debating and speculating about what counts as large. There are two different things being mixed up. A large transaction like a single payment of 2,000 and a large merchant like Reliance, where each transaction might only be 200 but the business overall is large. So who is large? Now both approaches come with their own challenges. Even if we say the cutoff is businesses with revenue above 1-2 crore. Now to know if this rule actually makes sense, someone needs to first calculate how much UPI volume happens in that segment and how much revenue would be the fee actually generate. Nobody except NPCI would have that actual data. Now coming to the large transactions, say above 2,000 rupees. This approach, an industry official said, is easy to game. Almost any e-commerce player, except maybe a mutual fund or insurance company who cannot easily split a policy or investment amount, can just break one transaction into two or more smaller invoices to stay under the limit and save the cost. Anyway, in both cases, I think we will be back to square one. Let's say, take a merchant with annual turnover of 1-2 crore and above, for instance. Many of these merchants are already paying payment aggregators bundled platform or payment gateway fees for UPI acceptance today. I'm talking about mostly online merchants. Now this raises an important question. If the government formally allows MDR of say 20 to 30 basis points, will payment aggregators absorb it within the existing pricing, or will they charge it over and above what merchants already pay? The answer matters because it changes the economics for everyone. We'll come to this part later. And then comes large merchants usually don't play by the same rules. There is another assumption worth questioning, that bringing back MDR for large merchants automatically means large merchants will end up paying it. This may not be as simple, by the way. Some of the largest merchants over the past few years have also become payment aggregators. Now what does this mean is, let's take Reliance. It is perhaps the best example. When zero-MDR was introduced in 2020, Reliance Retail benefited purely as India's largest merchant. Today, the group also owns Jio Payment Solutions, which has been aggressively building a merchant acquiring business. If MDR eventually comes back, Reliance could pay as a merchant while at the same time earn as a payment aggregator. If Jio Payment Solutions processes payments for Reliance Retail, much of the economics stay within the group. Now, Amazon also is in a similar position because it operates both as the largest e-commerce business and a payment aggregator. For these companies, MDR becomes less of an external cost and more of an internal transfer. Then comes to the final category, maybe large merchants that do not own payment processing business. We don't know, even some of them surrendered their own license. After the MDR, they might just reapply for the license, who knows. But coming back to, even if they don't have a PA business, what they could do is, the pricing may not work the same way policymakers expect. Large merchants will still negotiate aggressively. Let's assume if one payment aggregator quotes Zomato some 30 basis points on UPI, another may be willing to offer a lower price to win that business. So payment aggregators will not want to lose such high volume merchants and will end up competing on price again. In other words, bringing back MDR does not necessarily mean large merchants will pay the notified rate. Biggest beneficiaries if MDR comes back will be TPAPs, who also own PAs, which is PhonePe, Paytm, Google Pay, Amazon Pay. Also, payment aggregators who do not charge their merchants any fee on UPI transactions will start making some revenues. Now, on the other hand, PAs who are already charging merchants, if they stick to the new pricing, then they would see almost 80 to 90% of their revenue fall from UPI payments. Now coming to the TPAPs such as Navi, Jupiter, Cred, etc., who would be thinking that UPI monetization could help them in some way or the other and bring level playing field. An industry executive shared a very interesting thought on this. His argument is that monetization doesn't alone solve a market share problem. Imagine a UPI starts generating 100 rupees of revenue. The top 3 players with roughly 90% of market share will receive around 90 rupees and everyone else combined gets only 10 rupees. Now the largest players can easily use part of that 90 rupees to subsidize merchants or consumers by offering zero fees, cashbacks or incentives to protect their dominance. On the other hand, smaller TPAP with only 10 rupees in pocket will fail to match that spending. So instead of creating a level playing field, monetization could actually strengthen the incumbents because they have a far larger revenue pools to reinvest. I feel this is one of the most important aspect of the amendment that nobody is talking about. This could be a far-fetched, but still, this is how some industry officials are interpreting the bill. Now, the amendment does 2 things. First, it removes the linkage between the PSS Act and Section 26(9) SU of the Income Tax Act. Second, instead of referring only to specified payment methods, it empowers the government to frame rules for one or more electronic payment methods. Now, until now, any major change to the pricing framework required the government to navigate both the PSS Act and Income Tax Act. By delinking the two, the amendment reduces that dependency. In practical terms, it brings the decision making largely within the domain of the government and the RBI under the PSS Act without requiring a corresponding amendment to the Income Tax Act every time the pricing framework needs to be revisited. Now, the second change is even more interesting. The amendment is no longer confined to UPI or RuPay debit cards. By referring to one or more electronic payment methods, the bill gives the government the flexibility to prescribe pricing conditions or even pricing caps across different payment systems in the future. Does this mean government will regulate international card networks such as Visa and MasterCard? May not entirely, but for the first time, the legal framework looks broad enough to make that possible if policymakers ever wants to. Now, the question is, why would the government want such flexibility? When zero-MDR was introduced, the objective was straightforward: to accelerate the adoption of India's domestic payment network. Making UPI and RuPay debit cards free for merchants was the fastest way to drive scale. There was no attempt to regulate the pricing of Visa and MasterCard. But today, the context is very different. India is negotiating trade agreements with several countries, including the US. One argument is such negotiations has been that domestic policies should not unfairly disadvantage foreign companies. Applying that logic to payments, one could argue that while UPI is free inside India, it is priced in overseas markets such as Singapore and France. That opens up the theoretical possibility. Whether that ever happens is a separate thing altogether, but international card networks could say India is favoring its domestic payment network by keeping UPI free while competing against Visa and MasterCard. This is where the amendment becomes interesting. Now, rather than opening the floodgates, the government could in theory allow Visa or MasterCard to participate on UPI rails for credit card transactions, which is today only limited to RuPay credit card, but under government prescribed pricing limit. Now, the conventional card business could continue to follow existing commercial pricing, while transactions routed through UPI would have to comply with a capped fee. In such a scenario, the government could argue that the playing field is open to everyone while still retaining control over pricing. Visa and Master may or may not find that commercially attractive, but the policy option would still exist. Whether this is government's intention is impossible to say today, but what the amendment does is it creates optionality, not just to revisit UPI pricing, but to experiment with the pricing framework across multiple electronic payment systems, depending on future domestic priorities, regulatory needs, or even international trade negotiations. Here's my honest conclusion, and it is more interesting than will MDR come back, yes or no. Even if no circular is ever issued, even if this exact bill produces zero pricing changes in the near term, the fact of the matter is something concrete has finally happened. Three things. First, pricing decision will now move faster and involve fewer checkpoints going forward. Second, the door is technically open to price any network, including international card schemes, with real implications for trade negotiations. And third, and the most important part is, the formal RBI oversight of UPI pricing becomes far more plausible, which could finally bring scrutiny to the informal charging that has been happening since many years. If you found this video useful, this is the kind of reporting we do every week, which is going beyond the headline. We will be tracking this bill as it moves, and if any circular or rule actually gets issued, we will break down what they actually mean, not just what they say. Thank you for staying with me till the end. Please head on to our website, theheadandtail.com, for deep dives on fintech and emerging tech. Also, please share this video and subscribe to our channel. Thank you so much.